Dear clients, I'm Richard, Phillip CFD dealer. Markets muddled through the first half of May in relatively tight trading ranges amid the lingering Ukraine uncertainty and a mixed run of economic data. However, last week, all three major US stocks indices finally grinded higher to post positive gains for the year, with the broad-based S&P 500 index closing above the 1900 mark. Risk appetite rose as the Fed once again reiterated their commitment for policy accommodation, justified by lower than targeted inflation data in order to foster a still fragile economic recovery. Across the Atlantic Ocean, the ECB signaled a readiness to offer countermeasures against deflationary pressures, while China's premier said he may fine-tune economic policy to support current year's economic growth target. In other words, the equity space has arguably landed in the sweet spot of global policy accommodation, premised on low inflation with tentative signs of springtime rebound, coupled with a timely return of stability in the geopolitical scene, ushered in by decisive election wins in both Ukraine as well as Europe's last weekend elections. Hence, equity market participants decided to get ahead of the game to express their economic optimism in anticipation of firmer signs of recovery sustainability. On the cross-market front, a more guarded picture was depicted. For instance, US Treasury 10-year yield fell below the 2.5% handle for the first time since October last year, reflecting a diverging view of sluggish wage growth and a lack of inflation that may hold back economic growth. Meanwhile, the US bond yield story weighs on the US dollar, pending for more evidence of economic sturdiness. Most market participants would probably also notice that gold has tumbled back to Feb's level, which I believe reflects an unwinding of the safety bets placed earlier this year on concern of the Ukraine crisis and a US winter slowdown. Given that these issues have abated, the gold price action underscores investors' flight away from safe haven in favor of higher expected return spaces. Hence, in the near term, given the prevailing risk-on environment, risk-rewards seems to favor going long on market pullbacks. Having said that, market participants should be mindful of potential cross-currents that lies ahead as we navigate our way through a seasonally weak period for the equity market from May through August, followed closely by the anticipated end of QE, plus the US midterm elections towards the end of the year. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks, which are available with Phillip ETFs. With that, I've come to the end of the presentation. Thank you. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.